There are a lot of misconceptions with some marketplaces and mindset that if a property over the last decade has performed extremely well, it means in the next decade it's going to perform extremely well. But if we look at long-term history and data, that's not the case. The bottom performers in 1993 to 2003 are now the top performers in the 2003 to 2013. So it just showcases just because for that last decade, some areas have performed the highest doesn't mean that over that next decade that they're going to perform just as well. Some markets might perform long term, but in the near future, they might not perform as well as they have done, and vice versa. Some of those markets that have sat in flat for a period of time, they might overperform in the short to medium term. If you're expecting a property to double in a couple of years, that's just unrealistic for property. Property's going to perform strongly, then it might sit flat for a period of time, and then it will start to perform again. No marketplace can always be on the up. It's simply not the case. Welcome back to another episode of the Tailored Property Wealth Podcast. My name is Casey Taylor. I'm the host. And in today's episode, we're going to be talking about past growth versus future growth. And I guess out there, when we're looking at investing and looking at performance, past performance, future performance, I've managed to build a multi-million-dollar property portfolio in just a few short years, and I want to inspire and motivate other Australians that if I can do it, so can you. The Tailored Property Wealth Podcast has been created to help educate, mentor, coach, and support you through everything relating to property investing to make sure you go out there and make a much better educated decision when investing in property. Please like, share, subscribe, and share this podcast with anyone who you think might see value in it. There are a lot of misconceptions with some marketplaces and mindset that if a property over the last decade has performed extremely well, it means in the next decade it's going to perform extremely well. But if we look at long-term history and data, that's not the case. And a decade is a long period of time, but we really want to see trends over like a 20 to 30 year period. And that means that some markets might perform long term, but in the near future, they might not perform as well as they have done, and vice versa. Some of those markets that have sat in flat for a period of time, they might overperform in the short to medium term. And that's really why you need to do your research process before you go out there and purchase, because you can understand what marketplaces are going to perform well in the short to medium term. Because ideally, when you're building a portfolio, you want to get those properties in that next area prime for growth, right? Because that builds your equity. You can then use that equity to go into further purchases. And over time, if you're continuing to purchase and purchasing in those next areas, you're just going to diversify into multiple marketplaces, multiple states, because it's always shifting and changing depending upon where we're at in the cycle. All right. So I'm going to go through some data today just on the performance over some periods of time, because it's going to be really important just to kind of highlight what some marketplaces do over one decade versus the next decade. Okay. So cool. I just want to set the mood as well. Like I said, some marketplaces have that misconception that they're always the top performers, right? And there's certain people out there that will project that as well in the industry. But if we look at history, long-term data, it's not always the case. And the biggest one is Sydney, right? Everyone thinks that Sydney is always the long-term performer, but Sydney, Melbourne, Newcastle sort of follows that, but is a marketplace on its own now. They typically perform first, and then what happens is they become more unaffordable and that performance is there, then it shifts and other marketplaces perform better, which is kind of where we're at within that cycle. Sydney and Melbourne are more unachievable. But data from 1993 to 2003, for that period of time, there was three top performers, right? Obviously, so Sydney came in first with an average of 10.4% growth, Central Coast 10.1% growth, and Melbourne 8.6%. That was then followed by Newcastle Maitland, 8%, Sunshine Coast, 7.9%, Perth, 7.7%, Canberra, 7%, Gold Coast Tweed Head, 7%, and then Adelaide, 6.0%, and Brisbane coming in last at 6.1%. So that's kind of the order from 1993 to 2003. Now, I also just want to set the scene as well. Even the worst place for this period of time being Brisbane, 6.1%, that property in Brisbane is still doubling every 15 years. So that's just something important to know. And when we're kind of projecting with clients, we're always going off a conservative 5% growth each year. So even at 6%, worst case, it's still solid growth on average, which is still building your wealth. Now, if we go to the growth between then 2003 to 2013, the following decade, it kind of gets flipped on its head. So we actually have Perth in first place at 10%, Brisbane, second place 6.7%, Adelaide 6.5%, Melbourne 6.5%, Canberra 5.6%, Newcastle Maitland 5.2%, Gold Coast Tweed 4.8%, Sunny Coast 4.8%, Sydney 4.4%, and then Central Coast 2.8%. So virtually majority of the bottom performers from 2003 to 2013. Now, sorry, the bottom performers in 1993 to 2003 and now the top performers in the 2003 to 2013. So it just showcases, just because for that last decade, some areas have performed the highest, doesn't mean that over that next decade that they're going to perform just as well. And a big component of that comes into that affordability piece that we always talk about. For areas to grow, there needs to be income higher than median value, because that allows us to push prices higher due to borrowing capacity ceilings. And that's where some marketplaces that we're in now, Sydney, Melbourne, Canberra, they're kind of stagnating a little bit, not performing as well over some of those other marketplaces that are more affordable. Obviously, Brisbane has become more unaffordable, et cetera, but if you're looking local government area, there's still a lot of affordability. So that's just something to really understand when you're going out there and looking at areas. It's really good to understand, how has that marketplace performed over the last decade? And then looking long-term at that 20 or 30-year data. Because if an area, let's just say it's only done 5% on average for the last decade, but then we look at the long-term growth of that marketplace and it's sitting at 8-9%, we know based off long-term history that the chances are that marketplace, I should say, is now going to overperform over the next decade, which balances out that long-term average. So that's where you don't want to get disheartened or worried if an area hasn't performed over the last decade. So that's, I guess, the affordability piece. But then there's some other little bits and pieces that you can look at in a marketplace as well. And we'll get to some more data, but I'm just going off on my little tangent. But another one is gentrification. And a marketplace or a local government area that's heavily investing in that area to really gentrify that area, adding infrastructure, adding amenities. More people are going to move to those areas. And as prices kind of continue to push higher because of the demand in that area, it really starts to gentrify that area. It might push some of that lower socioeconomic stuff out of a marketplace. And then naturally people are renovating their properties. They might knock that property down and build a brand new property, and it just gentrifies that area naturally. So that's just something to really focus on as well. And that just, again, if you can get in before that gentrification happens, you're going to get really solid growth. And it's because the market's kind of underperformed. It might have sat flat for a period of time. So it's something to keep an eye out for. Thank you for listening to this episode of the Tailored Property Wealth Podcast. I hope you're learning lots and getting lots of value out of this episode. If you want to discuss the opportunity of working with us here at Tailored Property Wealth, jump across to the website www.tailoredpropertywealth.com.au, complete the contact form, let us know that you're listening to the Tailored Property Wealth Podcast, and let's reach out, let's have a chat and see how we can help you execute on your property goals. So let's jump back into some more data. So if we now look at growth from 2001 to 2011, now these kind of overlap a little bit over these long-term periods, but we have Brisbane in top spot from 2001 to 2011 at 11.8%, Perth 11.7%, and Adelaide 11.1%. Canberra 10.7, Melbourne 10.6, Gold Coast Tweed 10.5, Sunny Coast 10.2, Newcastle Maitland 8.9, Sydney 6.7, and then Central Coast last place at 6%. So again, like I mentioned in that last data set, even worst case, 6% capital growth on average per year, your property is still doubling every 15 years, which is not bad. If you're expecting a property to double in a couple of years, that's just unrealistic for property, and you probably need to go out and look at another asset class. But if you can have a horizon of a 15-year period, hold it for that period of time, worst case, your property's doubling, which is still an awesome result. And then once you stretch that out to a 30-year period, what's that going to do? So yeah, Brisbane first, Perth second, Adelaide third. And then if we're now going to growth for 2011 to 2021, there is some different top performers. Okay, so Central Coast coming in first, noting that it was in last spot in that last decade, 9.2%. Sydney in second place, 8.4%. Sunshine Coast, 7.6%. Newcastle Maitland 7.4, Melbourne 6.5, Gold Coast Tweed 6.5, Canberra 5.8, Brisbane 4.9, Adelaide 3.7, and Perth 1.3. Perth, we obviously know that they had a massive correction, and that's kind of inclusive of that data within that decade. And that's just why something, if you're thinking about purchasing in the Perth area, you just need to add that to your risk profile, and that's something we do for clients, depending where their portfolio is, if they've got enough diversification there to get into the Perth marketplace. Long term, it performs, but you just have to understand that it might have some bigger swings and corrections than some other marketplaces around Australia. So yeah, that second set of data, again, those top performers now become the bottom performers, and you can kind of see some correlations there. All right. So when we're going out and investing, it's always important to look at that past growth, that future growth, and really understand that, and then compare that to long-term performance as well. Because you can see patterns, you can see what might be, I guess, under market value with a lot of room to grow. And that's the areas that we want to be purchasing in to get that performance in the short to medium term, because then you can get that capital growth, you can get that equity to go into more properties. And this is really how you start to build that portfolio quite quickly, because if you're going out there and you're making these cash flow plays only, that cash flow is not going to help you save that next deposit sooner. The most powerful thing you can do is to get that capital growth component. You're really making money while you sleep. And if you've got good cash flow and just cash due diligence where you're continuing to save on top of that and have that surplus, you can definitely inject that back into further purchases, and it's going to help cash flow on the next purchase the more you can push into a deal. But where you're going to really speed that process up is that capital growth extraction to go into the next property sooner. Because the reality is, right, if we look at some of the properties we've purchased for clients in the last couple of years, they've done like 40% in a 2-year period. We bought well on the way in areas that are prime for growth. And like you just simply, in a 2-year period, some of those properties have grown, let's call it 150 to 200K. You simply cannot go out there and save that amount of money in 2 years, right? So if you were to go out there and save $200,000 over a 2-year period, that's $100,000 per year, right? I'm just going to do some numbers here off the top of my head. So you need to be saving $2,000 a week to get that same result from capital growth. Now, you might be able to do that. You might be slogging it out, working a couple of jobs, which I have done for a long period of time in the past to be able to save deposits. But I'm telling you now, I wasn't saving $2,000 a week. I was saving a lot. I was putting a lot away. But $2,000 a week is big money to be pushing away and saving. So just when you go out there and purchase, don't chase that cash flow alone. It's really getting those areas primed for growth and understanding that past growth versus future growth to know where we need to invest into next. And that's why when we're investing, right, at the moment, we're investing in Brisbane, we're investing in Adelaide. Like I said, depending upon clients' portfolios as whether we go into that Perth marketplace. And it has seen a big growth run as well at the moment. But right now, these are the areas that are performing well. And we're not focusing on Sydney and Melbourne at this time in the cycle. But that will change, right? And then we'll start to invest back into Sydney. We'll start to invest back in Melbourne, depending where that cycle is. So it's really being educated around the marketplaces, looking at the data, looking at that research component, because that's going to help you get that performance. Investing in property isn't guesswork. It really is. It's a science in a way, right? And getting that right is going to be crucial for you in a 15, 20, 25, 30-year period to be able to retire earlier, create financial freedom where you're not relying on a job to make your money. You might only have to work a couple of days a week because of the choices you made 20, 30 years ago. So it is super powerful to get those areas right because it's going to mean so many opportunities, options, and just create that freedom and those choices in the future. I hope you enjoyed this one, just touching on some of that data from past marketplaces, understanding how they kind of perform long term. And just to always keep in mind that when you're investing in an area, and I see this with some investors and clients, that once they get a lot of growth, sometimes they want to sell it and get access to that now. Or when there's negativity in the marketplace or whatever, they think maybe it's now the time to sell. Property's going to perform strongly, then it might sit flat for a period of time, and then it will start to perform again. No marketplace can always be on the up. Simply not the case. It is normal in Australian residential real estate to see a 10 to 15% correction. Not all the time, but over time, if you're holding property for a 15-year period, you are going to experience that. It is inevitable. It's the same with when we talk about interest rates. Your cash flow sometimes is going to be a little bit stronger than other times, and that's just not even relating to your gross yields and your rental income. It's simply related to where the cash rate's at, where the Reserve Bank is setting that, because that's going to dictate the rate that we're paying on the debt that we're holding. Sometimes the average rate's going to be a little bit higher than others. So that's going to fluctuate and dictate our cash flow a little bit. And right now we're in that environment where the cash rate is higher than what it was a couple of years ago. A couple of years ago, we were very fortunate. The cash rate sitting at 0.1%. So our rates were so low. Lots of property we were purchasing as positive cash flow, whereas that's now changed. It's going to cost you money to hold, and it's adapting, changing, I guess, your mindset, your expectations to the marketplace, but understanding that we will see rates drop in the future. Touch wood, it's pretty soon. But that's going to dictate our cash flow. So there's always swings and roundabouts. It's not always positive, but it doesn't mean just because we go through, let's call it a little bit of a bumpy ride in property in certain areas or whatever, or just the environment as a whole, that you offload that property and sell it. That mindset is very, very crucial for you when you're investing in property, because it's going to allow you to have that long-term mindset, hold long-term. Yes, you might sell some properties down the line to get rid of some debt, free something up, but you just don't want to do it in the short term. Build that foundational portfolio, hold it, really reap the rewards, and then down the track when you're looking to get into a consolidation phase, that's where you can really look at potentially offloading a couple of properties, for example. All right, we'll leave it at that today, guys. Past performance versus future performance, super crucial to understand when you're going out there and investing. Hope you enjoyed this one. I always love getting into some of the data because it's pretty black and white, right? Have a cracking week. I will just say, if you're listening right to the end of this, please jump across and give us a 5-star review on Spotify, subscribe on YouTube as well. Get that podcast out there to more people. I'd really appreciate it. Thank you. Have a good week. See ya. Thank you for listening to this episode of the podcast. If you don't already, make sure you follow us across all of our social platforms. That can be Instagram, YouTube, LinkedIn, Facebook. I wish you all the best out there on your property investing journey, and I hope each decision you make in purchasing more property gets you closer to your goal of financial freedom.